Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on February 10th. My name is Ian Saunders, and joined here as well with Steve Raymond. Steve, it's good to be in the office and here talking to you across the table.
It is great to see that we're here doing good work as we open up a seasonal new year.
Yeah.
So thanks for having me.
Yeah, no, it's been good. And it's certainly been some good work that the market's been put into throughout the course of this year. It's been a couple of weeks since we talked about the U.S. equity picture. But the default chart of the S&P 500 index has just continued to rocket higher, right? I mean, we've gotten 5 consecutive buy signals on that default chart, moved back into a positive trend, a little bit of a pullback over the past few days, looking like it might want to reverse back down into a column of those, but pretty consistent improvement higher from the broader domestic equity space. I mean, you look at the S&P, it's up over 7% on a year-to-date basis so far. Up over 5.5% over the last month, right? So I mean, just over the last 30 days, even though we're not much more than a month into the year. Yeah. But it's that January effect was in full effect to start off 2023.
I know that different talking heads across the nation will put it differently, like it's one of the biggest moves that they have seen in January. But I would say from our point of view, it was a massive move in our all equity funds score, our core scores. I mean, it's quite notable. Yeah. I wouldn't get used to scores moving this much on a monthly basis, but certainly caught everyone's attention here, helped us with our modeling and other things to catch some of that early part of that move. But yeah, you have a substantial U.S. core preference in part of this market. But I don't want to discount the fact that a lot of different asset classes have moved higher. It's almost like a broad bullishness across all different types of assets, just not only the S&P 500, although the S&P 500 is kind of since I'm more core centric, of course, the S&P 500 is a centerpiece, but it's not the only piece.
Right. And I think that score move, I mean, it's part of the reason why we wanted to have you on and kind of have your expertise with this latest, as you said, this latest seasonal evaluation. So we had many of the fund score method, the FSM models that we have on the system were evaluated late last week, and with trades coming out there last Friday. Right. So we felt very timely to kind of get on and dive into some of this score move. For those listening might not be as familiar, when we say fund score, right, it's a scoring system, scores from 0 to 6. 0 is the worst, 6 is the best. And I know you were kind of one of the mastermind putting it together there, right?
Yeah, I'm sure I was one of them. The idea is to kind of transfer to a numeric value or a number all the inputs of many variety of mathematical inputs, including charts. So it's a quick identification method in order to say, where should we participate, where the leadership would be, and where it just moved into, or whatever the case may be. And so the fund scores are moving, have been moving, of course, all of 2022. But in the last part of 2022, in October, we started to see some directions and
thematic
fund score movements that also led into January.
Right, and so I mean they'll typically change. They'll change every day, right? It's just a matter of the magnitude of that change, right?
We're looking. The sense is things can change every day, but they're not tuned to the point where they just wildly say different things every day. They're thematic. I mean, our belief, or one of our beliefs, is that the market travels in a thematic way. We want to catch that theme. We want to catch that trend, and stick with the trends, and change when those trends change. So the models are reflecting that discipline, doing the same thing. In some sense, the scores damper the noise of the market moving around, and in the other sense, it picks up trending components and thematic components that are important to stick with. I'll give you a good example. So we have some core indicators that really throughout the year of 2022 remained generally positive, and so that helped our models stay with full exposure for the most part. Now, a lot of people didn't like that.
It's always hard in the moment.
Yeah, right? A lot of people, would say, well, no, we should, get out of the market and do a lot of things. But that's the whole point of the indication. If the if there's a strength that we want to hold on to, the models are going to hold on to it. So just bear that in mind, that the core readings have been relatively high all year, and are very strong as we came into December and into January. So there are some very strong indications coming into 2023, and they're still strong.
Right. And when you say core, you're looking at that core S&P 500 kind of group representative in that asset class group scores page. And what, 135 different groups that we're tracking in there. And
yes,
so seeing that core sit at 88% through movement yesterday, I mean, that's pretty high relative to everything else. But like you said, it remained up there. Certainly north of 50 throughout the turbulence over the past year.
Yeah, in fact, historically, there are many types of markets that people would quote unquote call bear markets. And, in many of them, the core does not survive. So there's a defensive element, a hyper defensive element because of that. This was just happened to be one where the core held in there. You could almost think of it as saying the market played defense holding the S&P 500. And then ejecting every other asset class. In other words, that's kind of the 2022.
Because usually you move to like fixed income. But fixed income was not scoring very well throughout most of last year.
Right. When you strip away everything that's not in leadership, that leaves you with leaders. So even though 2022 was a very, very rough and tumble, what I would call bearish market, among the survivors and the leadership within that context is the S&P 500 related type funds, growth or more so value and low vol mixtures there. And of course that, historically that doesn't always happen that way. It just so happened that 2022 is a firm example of that. Right. And of course we're still moving ahead. We didn't write the last chapter of the book yet because we're still playing the game. I say that somewhat in jest, but somewhat not, because in 1999 we actually traveled through 2000, 2001, 2002, 2003, 2004, before we really started to, shape up, and get out of that type of market, what I would call period. So, like I said, what we do is try to play the game on a month and a quarterly basis without doing too much prognostication of what the future will be. Where the models adapt to those changes as they come, if they really do come.
Right. And so some of those changes that we did see. So we saw the core hang around, but we also saw the money market percent rank, right? That cash proxy. That shot pretty high last year, and it remained north of that 50% level a little bit longer. There were some bear market rallies in there where you looked like things were getting better, but that thing was hanging around at kind of upper echelons of scores for a little bit there.
Classically from Dorsey Wright, the money market indicator is one of our, another form of a defensive offensive indicator. And it was glaringly smoking red defense from that point of view, and remained that way for much of 2022. What was going on there, again, back to the earlier comment, is that you had so many asset classes around the world in distress, phenomenal amount, quite frankly, including fixed income, which is historically not the case. In other words, historically, fixed income has always come to the rescue in turbulent markets. 2022 is an example of where that was not the case, and the money market indicator became a very dominant defensive mechanism. Right. With that said, the money market indicator started collapsing at the end of 2022 and has come down to full normal field position.
Right. I think I was looking at this on January 4th. It was at 50, and then it just kept falling.
Right.
You're down at what, 16% right now, which is pretty normal ranges.
Yeah, I think again, historically, ranging from 2 to 15%, it will float around in that area. And that's kind of you kind of call that a nominal or a normal environment, because there's always some asset classes that getting in trouble, a handful that go out of favor, and so the money market will float up between 2 and 15. Some markets, there's everybody's doing well, and so the money market's riding around. Generally, you don't see it below 2%. But the reason we have it is really to be an indication of how many asset classes are doing better than holding cash. on a technical basis.
Mm-hmm.
And then that gives you some idea of what kind of market you're dealing with. So right now you're dealing with again, 85% of the asset classes around the world are in better technical shape than cash. And that's actually, pretty bullish, very bullish. And quite frankly, is a breath of relief in that in 2022, we really struggled with finding groups that were superior to the money market.
Right. And I mean, one of those areas that you and I were talking about before hopping on here, that's just, I mean, rocketed higher across the board, international.
Yes.
Right? I mean, you've seen, I think I was looking at these rankings, you see almost every international representative, except for India now. India's seen a little bit of a backdraft, but almost everything else is above that cash proxy, that money market proxy, and a lot of funds in kind of upper echelon of they're above that 3.0 score threshold. And I know we saw some of the models, those FSM models that we touched on that were evaluated last week. Many of those begin to tilt a little more toward the international side. But we certainly saw in something like T-Row, right?
Yes. T-Row Price is one of our flagship FSM models, as well as American Funds, to name two. And in both cases, international funds moved into that lineup to the degree of 2 or 3 out of 5 funds. And I think what's notable about that is that we haven't seen international really move into kind of the top inventories. It's been years. It's been years to see 2 or 3 move in. So
right. One is rare and seeing
we so I think you're in a different market type here. Let me fill that comment with something like this, is that the international space was decimated in 2022 to a degree that is literally phenomenal. Halfway through 2022, remember that the international markets started selling off well before 2022. You could say they were the first to stumble, and then continue that stumble.
Mid 2021 for some of those areas.
Way back. So, and again, our models were not participating in that area for those technical reasons. So that's the good news. But then we got to the point where we measured scores in the international funds that we've never seen on our system before in 20 years.
I thought things were hitting zero.
Yeah, and of course in other systems that go back further, the similar tone, phenomenal overselling. So what you got there, I think, is you're building value when you take groups like internationals down to below phenomenal low levels. There's a value that is created there somehow to where people come back to it, and that's what we saw here. Really, off the low scores in the international group, people started coming in. And if they weren't coming in, they were talking about coming in.
Right.
And if they were talking about coming in, they got drug in. So the idea is that we've had a phenomenal retracement back into some international strengths there, which makes sense from the context of what we just talked about over the last few moments. And that might lead to something. There have been many years where internationals can hang in there and be a great help and a great leadership for multi-year periods. And again, most notably are markets where the U.S. struggles. The internationals are usually always there. And so where do we go from here? Well, that's what we do, on a month and a quarterly basis. We just keep going with it. But I would say that what you're seeing in the FSM models, or what you're seeing in other things you may do in your matrix, whatever you're doing, is you're seeing strengths that you haven't seen in years.
Right. I mean, we saw on the T-Row side, I mean, two international funds within that inventory, and it's value international too. I mean, it's not like we're talking risk on tech international growth. I mean, it's international value, something that at least my short time here, I had not seen that in a many models.
Right. The last 3 or 4 years have been a first in a great while of a lot of things.
Right.
And this is just another where your developed Europe exposure, which generally doesn't have a long history of just beating emerging market exposure.
Right.
Really came to the light on this deep value rebuying, reinflating. And that's part of that international value story is developed Europe. So though, and I think that's the wisdom of the inventory, meaning that's why we have so many different selections in the inventory, because we don't prognosticate which one will do well.
Right. You let whatever's doing well float up.
Right. We more allow the inventory to speak about, what the technicals are and where the leadership, is moving to. And that's what we're doing here. So even though we rarely would see international value in a lineup like a T row lineup, which is most known for how aggressive in growth it can get, keep in mind the inventory allows it to get aggressive in value.
Right. They still have an international value fund, so it can still float up.
That's right.
And even on the other shops that might not be as typically risk on centric. I mean, American funds, one that kind of comes to mind, is a little more diversified, right? And we saw 3 changes in that model too. Yeah. I mean, there's been a fair amount of changes on the American funds inventory from a holdings perspective in those models over the course of the past year or so. But I mean, 3 funds going out, 3 new coming in. Again, more international. Right. I mean, we're seeing kind of consistency across some of the models, which I mean, kind of speaks to maybe the weight of the move. Yeah. The importance is American funds has an excellent international diversified international lineup. It just so happens that we've got more of their developed international lineup versus, let's say, an emerging market lineup, which may come later. Right. These things they had a lot further to go higher. Yeah, they were, it is, what will be. And but also in American funds, there were beefed up what I call correlated fixed income. So if you think about plain vanilla aggregate fixed income, is not really correlating with the stock market, but correlated fixed income, like, for example, high yield or dividends and income strategies and things like that. We call that correlated fixed income because they tend to correlate more towards the economy and more in some sense to the stock market. And so American funds did beef up that part of that section. So you could say that this is a pretty solid allocation with more correlated fixed income and more international than it used to have. So, again, overall a conservative mix. It's not a racehorse mix, but that might be the flavor that we need to be in for the rest of 2023. Right. We don't know. But that's where we are here. And so we go through this juncture for a quarter. Of course, people do look at these types of models monthly, make their own decisions. But I think we're in a solid start of diversification. That's for sure. Meaning, in a good way, that not all the eggs are in one basket. Right. Right. You see, some markets are different, like where you have a hyper growth market where only semiconductors are working, and the temptation is to only do those things. And then when those things break down, you're in real trouble. So you really do prefer, when possible, to have diversification. Some value, some growth, some international, some fixed income, some correlated fixed income. When you have those all together, that can really work. Some people say, well, that won't work so well because you're so diversified. But keep in mind that this is the kind of market that this one, meaning 2023, where you have a lot of asset classes that are reinflating, if you will, that are doing better, much better in scores and improving in scores than where they were, a year or so ago, where they were falling in scores. So it's not just U.S. equity that's improving. As we're saying, there's a lot of different bandwidth there, and that's actually pretty good. And hope that continues. Having a global rally, unfold and blossom. That's a super. It's a lot of breadth. Super type of market that you want to participate in. Right. If you're following the models, follow the models. Don't wait and see what happens before you follow. No, get in the models
and let's keep going, because February is now, and then that will lead to May.
Right.
And then that will lead to the summer and things of this nature. So way too early to tell that international won't do a lot better and that emerging markets will come on. It's actually too early to tell that growth might not come back. Maybe there is some growth coming back, but that's what a model will do, is pick up those core themes as well as any outliers that are doing well enough to substantiate. Because remember that, like in T row or American bonds or other inventories, each fund's competing against all the other funds. I mean, it's not so easy to, if you say, well, who's the number one fund in American funds? Well, it's not so easy to get there, right? I mean, that was a hard journey. Right now, it's fundamental investors, and as you know, or the folks know that use American funds, that's a wonderful kind of value ish type of U.S. equity fund. And then number two is a international growth and income fund. So it's kind of giving you that broad.
Right. You get a little bit of exposure in some different areas there. Yeah. And I know that, American funds, those are some areas that were in some of that kind of broader model of models, which we wanted to touch on. But before we dive into that, I think it would be good to touch on something that didn't see a change, right? Which was, I think, is perhaps as important as something that did change, right? Yeah. And we're seeing consistency of movement. And that was in that, the core solution suite, looking at more the ETS side of things, that all cap world model had a pretty solid performance. Up 8.6% so far this year, outpacing that all cap world or ACWI representative. It continues to see strength in large cap value and large cap equal weight. Right. Those are the only two areas in that inventory that score north of that 5.0 score threshold, which is a pretty notable movement, right?
Yeah, and it's profound, because the equal weighted S&P is sometimes I refer to it as a magical vehicle, in that it can participate in a lot of different market types very well, whereas other things can't. So this model latched on to the RSP somewhere, much earlier into, actually all the way through 2022. The point is that it latched on and didn't need to see a change. In fact, do not change for the sake of changing. In fact, what we would prefer is that the market always delivered trends and themes that never changed, and then we could all just participate in that. But then,
that'd be great. Keep them going.
But then we, some firms will be out of business if that happens. But here's the point: is that we don't change just to change. And so if the technical relative strength is dominant in a certain inventory, it's going to ride with it. And so I think it's done exactly what we wanted, coordinated it to do way back. It's not like we get in there and fiddle with these inventories. Certainly not too often. So it just rode through 2022 with relatively low turnover, all things being said, and came out into 2023 with what it ended up with in 2022.
Right. And we're seeing that continue. It's a good thing. And those are two of the areas. I know we wanted to hit on that tortoise and hare model, right? Yeah. That kind of model of models format. We talked a lot about different kinds of models: your T row inventory, your American funds inventory, your ETF inventories. Yeah. And I know that tortoise and hare format is something we can kind of blend those together, right?
Yes. It's the idea is to say, how do you take the wonderful scores and wonderful models, but put them into a coordinated theme where you could say, hey, I want to work with my high net worth clients, and we want not just two funds or one fund or ETFs. How about some mutual funds and ETFs, and kind of build out a full allocation? And that's what the tortoise and hare does. It tries to stick with an 80-20 mix, meaning 80% equity, 20%.
It does that because it has that minimum bond exposure in there.
Right. So it's going to stick with an aggregate fixed income, like from Vanguard. It will also oscillate with other fixed income opportunities from, let's say, like Franklin, where like Franklin went from more of what I would call plain vanilla fixed income, low duration types of things, and then it's moved right into what I call correlated fixed income, which is more of high yields and income related dividend strategy, things that would be in concert with correlated fixed income. So it moved right in there. So it convertibles, things like this. So it gives you a mix. It gives you an active mix of how to handle that fixed income 20% piece. And then, as we talked about earlier in this podcast, moved into a healthy bit of international. So you're picking up American funds and T. Rowe Price international funds.
So it's a model of models for
It's
them.
a
So
model
those
of-
changes
right.
are carried over into this other broader allocation.
Right. And in respect to equity, let's say U.S. equity, it moved a substantial amount of U.S. equity out of U.S. equity and into international. So it did several things at once. It's kind of a beautiful thing to watch. It lowered cash, right? Because it had like about around 20% cash, went down to 5%. So it lowered cash, and then lowered U.S. total exposure, moved into international, beefed up correlated fixed income, and then also added some small caps. So it's like a 3 or 4 or 5 ring circus all at one time.
Right.
And the beauty of that, if you think about that, it saves someone, possibly like me, from trying to say, well, do we got how many moves do we got to make, and theoretically try to trace through every move and just say, look, this is where this is not only where the relative strength is, this is the mix of relative strength, and it happens on its own merit, not because someone said, well, we think that it should do that. It reminds me of a story I remember some years ago, but not that many, let's say 5 or 6, 7, whatever. There were many firms out there on the street that prognosticated that international should be overweighted in those times as a theme, and it turned out they were some 5 or 6 years too early. It really hurt. So we don't dictate the international versus U.S. and some other things inside a model. We go with what it does as it ratchets into where the leadership is. I do think that maybe there should be some guardrails not to allow something to become fully this or fully that.
And that's you have the fixed income specific models, and you have a couple equity specific models.
Yeah, like for example, inside the tortoise and the hare is also the U.S. core FSM, U.S. core, and it's not allowed to do anything but just U.S.
Right.
So there are constraints, here and there, but they all work in a grand design. So like I said, we feel very, very, very strong about this. Keep in mind that just because you have wonderful score systems and wonderful models, it doesn't mean that the market's going to behave and you're going to have a great time through the market every year.
Doesn't always feel great.
These things are going to plow through and take some dents in the doors and get bounced around a little bit, but that's reality. And that's okay. But then here's the strength of that when the market starts to pick up steam and recover to some degree, they're there.
Right.
They're already ratchet. They're already in place. And this is very important because some people suggest it's hard to, get out of the market and raise cash. And I say there's some strenuous issues with that. But it's much harder to get back in. And that's why you want your model engine, your model strategy, your the things you do, your own business. You cannot get left behind by market. You got to be there. And so the models really are there.
They're objective, the rules based.
Right.
They'll
rules based.
Right. And so they're making some decisions that sometimes you don't want to make. Or you don't.
Here's one.
Yeah.
There's no one in the middle of 2022 that I was hearing out anywhere that said, let's go ahead and put 25%, 30% international into the mix. And they certainly weren't doing it January of last year. Had they done that, they would have been severely wounded. The point is if someone back a year ago said, well, we think we'll be a big stake in international, well, that's very difficult to prognosticate.
It's got to come back sometime, but it's that timing of it, right?
Right. It's like remember that back in the old days, energy was a major sector in the life of my youth as let's say a financial advisor. Then it went away for 15 years or 20. See, and then it came back, and it has some great promise over the last several years, and still may going forward. So you never really should prognosticate the when something will come back. It could be, it could outlast you, that it doesn't come back and hurt you. So what we've learned we've learned a lot from market types over the years. And one thing we've learned, we go with what is. And we go with what is, and when that changes, we change.
Right.
We don't wait around on the changing. If it changed, we change. And then we also don't prognosticate what it should be or what it will be down the road. We just go with it. And I think that's kind of what you get when you work with our firm, Dorsey, Wright. And I think that's what people want.
Right. And that's what you get with these models too, that's right? Correct. I mean, you're getting the allocation, the top scoring areas of place. I mean, those trends that have been established and hopefully will continue to establish until that next evaluation. So these models were evaluated last Thursday, right? So they'll be evaluated coming up at the beginning of May.
First week in May
that we'll look toward. And that's that whole seasonality aspect of those quarterly evaluations. We're selling May, go away, come back to November. Hopefully we won't be selling a lot. I guess we'll see what the next few months shake out to be.
Like I said, I think that since maybe 2017, it's been difficult to prognosticate the seasonal effects and what they'll be. So it's important for me to make the statement. The models do update in these timeframes, but it doesn't force them to do any particular thing.
Right.
It's coming back to check on how things are going. We also have monthly models, so keep in mind that we have this frequency of monthly or quarterly. We don't make them change. We allow them to take a look, meaning the model takes a look at where the prevailing technicals are, and if there's a change that it can make, it will make it. If there's no change, it will not make any change. So who knows where the May or the summer orders will be. But what we do know is that the strategy's been set up to go ahead and it's going to participate. Right. It's going to get in there and do participate. And I think that's what you want your strategy to do. Markets like this that move at this velocity, they're a little different than in some sense markets of the 80s or 70s, in that you've got everybody in there, people they know in core centric type strategies. So you have bigger moves faster, and what you want to rely on is that the technicals of an FSM model keeps you in the game. Right. Keeps you in the game and right in the middle of the sweet spot that inventory allows for. And we even have international. We have an international only. FSM.
That core constrained international, right? With a lot. I mean, those are one of the, given the ranking of international across the broader kind of relative systems that we have on the site, seeing international up towards the top. I mean, that's going to be that first in a FSM model that many people see when they're logging in, which we saw an interesting, and that's not in that kind of broader models format, but we saw an interesting trade there too that looked at, again, strength international, wasn't 50% cash, moved back into broad developed exposure. So that developed exposure, like you talked about with some of the other models, I mean, we're seeing that play out against different models and different kinds of assets, whether it's mutual funds or ETFs. I mean, it's all those scores are rising. Yes. And the idea that, we do use cash in many of our models, certainly FSM uses cash here under definable rules. And that's meant to save life. I mean, if you go into a certain set of inventory and you don't have any access to a cash component, you can pick up some serious damage. It's a tough decision in the moment to make. I'm going to move always cash. Let that objective model kind of do it for you. Right. But the model, again, is set up to make sure it gets back in the day it can. There is no psychology or, to it, because really the markets really will stress human psychology. The models are soulless. Right. So the day they can go back in, they're going back in. And that's what you want. You definitely want that ability to, like I said, we could say it different ways. To raise cash and to go back in are vital abilities, but you got to do both.
you can't say, well, let's raise cash and never go back in.
It's almost more important to get back in.
Getting back in is really the key to the multi-100-year or the 100-year market that we know of. So I think that these models are excellent to use. And then of course, as you use models of models or other parts of our toolkit, this idea bleeds right down through all of it.
Right.
I mean, the ability to play offense, the ability to play defense, and the ability to come back to offense.
Right.
So, that's crucial. Along the way, then you also pick up these trends, let's say a value trend versus a growth trend, or how about its value for a while and then it goes to growth, then it goes back. These are extremely difficult for the human financial advisor to kind of do. Let the models do it for you.
Right.
That's what they're there for, and they do an excellent job at that. They are following true market trends. The question is will the market always trend this way? We don't.
And that's why we'll wait and see until we get alerts, right?
Right.
And so, I mean, for those that are kind of following along, do have access to the platform, that are following some of these models, I mean, make sure you have the alert set. That's one thing that I've heard from people calling in that, hey, I saw that these were evaluated. Well, you can click that alert button on there and definitely make sure you get an email if there's change in these models down the road. And then if you want any kind of help pairing some of these together, like what we kind of talked about. I mean, there's that Torch and Hare model of models that's pre-built on the system, but the Dorsey Wright team's more than happy to kind of help you out and kind of pairing things together if you want to dive in any of that. But I mean, with that, Steve, I think that wraps up most. I mean, we could sit around and keep talking about different score changes for a while, but I think that wraps up most of what we were looking to cover, at least here this week. So Steve, it was great to have you on. Thanks for coming in and kind of sharing your insights on those.
I really appreciate being here.
Great and wonderful. And thank you very much for everyone for tuning in this week. And we'll be back to talk with you next week.